Is GoDaddy a buy or a sell? Let's get started with the model. This is a large cap company, 29 billion market cap. They're trading at $205 a share, and they have 140 million shares outstanding. GoDaddy is the world's 5th largest web hosting company with 62 million registered domains. Founded in 1997, headquartered in Tempe, Arizona. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doubled from 2021, 600 million to 1.2 billion. And their margins are improving a lot from 15% to 27%. Anything above 20% is usually a pretty good margin. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's grown a lot from 240 million to 1.9 billion. Look at those margins, 41%. That means they convert 41% of their revenue into net income. Revenue is the sales for the company, and that's not growing that much, from 3.8 billion to 4.5 billion. But they're so much more profitable than before, which means their revenue is going up a little bit, but their expenses are going down a lot as a percent of their revenue. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4 at 38 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $33 billion. We divide that by 140 million shares. And we get a calculated stock price of $237. They're trading at $205, so they're trading at a 14% discount. It's a buy according to the model. Finally, a buy. It seems like we had a long string of sells. There are 152 companies in the same industry as GoDaddy, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 16 million, a little more than median. They're by far the most leveraged company on this list, almost 11. That means for every dollar of equity, $11 of debt. Debt is a great way to scale a business because it's cheap financing. Equity is expensive financing. They generate 1.2 billion of free cash flow, which is more than Palantir. And Palantir is 5 times the market cap. They rank 11th in market cap, 29 billion. Their price to book is 81, probably all that debt. PE looks really attractive at 16, one of the better ones on this list. Price to free cash flow 23, a little worse than the median. Price to sales 6.4, they're trading 6.4 times revenue. They generate 4.5 billion of revenue, which is more than Palantir. Their 5-year annual revenue growth rate is 9%, which is lower than the median. And they're trading close to their 52-week high. They're trading at 205. 52-week high is 209. So you might want to wait out this one till it comes down a little bit. If you put $10,000 into this company 10 years ago, you'd be real happy at $79,000 today. That's a 24% annual return. To summarize, I have them trading at a 14% discount, ranking 6 out of 10. Would I buy it short term? 5 out of 10. It's trading close to its 52-week high, so I might want to wait a little. Long term, I think it's a good investment. I like that company. I like their business model. 7 out of 10. Ratios are pretty good. A good PE, but the other ratios are a bit high. Financial, 6 out of 10. Really impressive free cash flow growth. Revenue is not growing too much. Only up 17% since 2021. Let's look at their income statement. Here's the third quarter 23, third quarter 24. Revenue is up from 1.07 billion to 1.15 billion. And they break down the revenue between applications and commerce, 420 million, core platform, 720 million. Let's see if they give a different breakdown of the revenue. Here's a different breakdown. Applications and commerce, 423 million. Core domains, 535 million. Core other, 189 million. And they're not too concentrated. Not one customer is over 10% of their total revenue. US revenue under 800 million, international under 400 million. Both have gone up from last year. Let's look at this income statement. It has percentages. 37% of their revenue is applications and commerce, 63% core platform. Cost of revenue is 35.5%. So that means their gross margins are 64%, 64.5% to be exact. Last year, their gross profit margin was 62.9%, so it's moving in the right direction. Their A&C revenue went up 16% from last year. Core platform up only 3% from last year, so their total revenue increased 7%. The increase in ANC was driven by a 20% growth in revenue related to productivity applications, mainly from their pricing and bundling initiatives. 9% growth in revenue due to continued customer adoption of their subscription-based products. Those are designed to establish and grow an online presence. A big growth, 60% in revenue related to their commerce solutions, as continued customer adoption has resulted in an increase in payment volume. Let's look at their expenses. Technology and development, $200 million. That's 18% of their revenue. Last year was close to 19%. Marketing is 7% of their revenue. Last year, 8%. So they're really doing a good job at managing expenses. Customer care, 6% of their revenue. Last year, 7%. So it's going down in every category. G&A, 8.2%. Last year, 8.6%. So their total expenses, $890 million, which is 78% of their revenue. Last year was $900 million, 84% of their revenue. So their operating income, $250 million, operating margin, 22%. Massive jump from last year of 15.6%. So that means they convert 22% of their revenue into operating profit. The other 77.9% are their expenses. Right here, 77.9%. They spent $39 million of interest on their debt. Last year, $44 million. Pre-tax income, $221 million. $30 million of taxes. Last year, they had a tax credit of $3 million. So their net income, $190 million, compared to last year, $130 million. Net profit margin, 16.6%. Last year, 12.2%. They're doing a phenomenal job at building their margins. Let's calculate their EPS. That's net income, $190.5 million, over shares outstanding, 140.5 million. That's $1.36. Last year was 90 cents, because last year they had more shares outstanding, 5 million more shares. Last year was 145 million, now it's 140 million. Not only do they have less shares outstanding, they have 60 million more of net income. So they killed it on both fronts. They reduced their shares and increased their net income. You can't ask more than that if you're a shareholder. Let's look at a balance sheet. Current assets, $1.6 billion. Current liabilities, $2.8 billion. So they have a pretty low current ratio. It's below 1. But I wouldn't worry too much. As long as they have positive cash flow, it's fine. If they have negative cash flow, that's a big red flag. They have $800 million of cash on their balance sheet, up from $458 million. $90 million of accounts receivables. This is how much money is owed to them when they sell on credit. Prepaid domain registry fees, nearly $500 million. So that means customers prepaid for items. This is an asset to GoDaddy because they prepaid these fees. The reason it's an asset to GoDaddy is because these customers owe them for their registry fees. So when the customer pays for their domain registry fees, this $490 million was already booked as revenue for this company. So whenever the customer pays for the domain registry fees, then they'll remove the asset. It's similar to accounts receivables. Deferred revenue is the opposite. Deferred revenue means the customer paid already, and it's just sitting on the balance sheet waiting to be booked as revenue. This has already been booked as revenue. Accounts receivables was booked as revenue at some time in the past. This company is just waiting on payment from the customer. Their biggest asset is goodwill, $3.6 billion, so they do lots of acquisitions. Intangible is $1 billion, so $4.6 billion of intangible assets. Of the $3.6 billion of goodwill, $1.5 billion is acquisitions through their ANC segment. $2.1 billion of the goodwill is acquisitions through the core segment. Here's the $1.1 billion of intangible other. $445 million is trade names and branding. $230 million domain portfolio. Contract assets, $300 million. They have $1.2 billion of deferred tax assets. This will help lower their taxes in the future. So total assets, $8 billion. Last year, $7.6 billion. They have a lot of deferred revenue, $2.3 billion. This is when they receive payment for their service up front, and it's carried on the balance sheet as a liability. When they perform the service, they'll remove the liability and book the revenue on the income statement. They have another $900 million of long-term deferred revenue. Their biggest liability is long-term debt, $3.8 billion. Here's a breakdown of the long-term debt. Their 2029 term loans, $1.5 billion. Pretty high interest rate, 8.4%. Their 2031 loan, $1 billion, 7.5%. 2027, 7.4%. That's paid off. 2027, 5.5%, $600 million. And their 2029 notes, that's a low rate, 3.6%, $800 million. Assets minus liabilities equals equity, $350 million of equity. They raised $2.5 billion from selling their business, and they lost $2.3 billion from running their business. But I think the main reason they have an accumulated deficit is because they buy back so much stock. If they didn't buy back so much stock, it would be positive. Let's look at a statement of cash flows. This is the trailing 9 months. In their operating cash flow section, they generated $950 million of cash from running their day-to-day business. Last year, $750 million. The way you calculate that, you start with your net income, $740 million. You add back the non-cash items on the income statement, $100 million of depreciation, $220 million of stock-based compensation, negative $213 million from deferred taxes. They had a big cash inflow of $260 million of deferred revenue. In their investing section, they only spent $12 million of PP&E, last year $38 million. In their financing section, they added $2.8 billion of term loans. That's a lot of debt. They bought back $670 million of common stock. Last year, they bought back $1.1 billion. And they repaid $2.8 billion of term loans. So when debt is due, a company usually doesn't use cash to pay the debt. They take on new debt to pay the old debt. So the cash at the beginning of the accounting period is $458.8 million. And then when you sum up operating cash flow, investing cash flow, and financing cash flow, the sum of those three numbers is roughly $300 million. So the cash went from $458.8 million to $767.1 million. That's the cash at the end of the accounting period. So as of 9/30/2024, this is how much cash the company has in its bank accounts. That number will match the balance sheet. So if you scroll up to the balance sheet, it's a few pages up. Let's keep scrolling. It's right here, $767.1 million. The beginning cash was the end of the last accounting period, $458.8 million. Let's look at a company on Simply Wall Street. Its last price, $205, 29 billion market cap, down 1% in the past week. Look at this, up 94% in the past year. Who would have thought GoDaddy would be up 94% in 1 year? It looks like they started trading in 2015 at $26 a share. The stock pretty much only went up. There wasn't many points where it dropped. In the first year, the stock went up 200%. It tripled from 25 to 83 in 2018. Only 3 years to have a 200% growth. It took about 6 years to break through the 2018 high. And you can see this horizontal dotted line. It barely breaks through 80. It barely breaks through 80, and in 2020, it came down to 44. So if you got it at 80 in 2018, you would have had to wait 5 years till the end of 2023 to get back up to your cost basis. But that's when the stock took off. From 88 at the end of 2023, it broke through 200 just this month. It hit 209 in the beginning of this month. Now it's trading at 205. You just don't know when a stock's going to take off. So sometimes you have to sit on it for a few years. And it could be painful because some stocks never take off. And it's a total waste of time and total waste of money. But we can't predict the future, right? Simply Wall Street's valuation is $342. They say the stock is 40% undervalued. 17 analysts priced this stock at $195. They say it's overvalued. Their revenue in 2013 was $1.1 billion. Then it took 4 years until 2017 to double to $2.2 billion. And then it took 7 years to double again from 2.2 to 4.5 billion. That's where it is right now at 4.5 billion. They do have quite a bit of debt. It was over 1 billion in 2013. Now it's close to 4 billion. And their equity is sometimes negative. Right now it's real small, only 356 million of equity, 3.8 billion of debt. The way I look at it, they need a minimum of $200 million of cash to service the debt. If you just round up to 4 billion of debt, you take 10% of 4 billion, so you knock off a zero, that's 400 million. Half of 400 million is 200 million. So 200 million is roughly 5% of their debt, which is about the average interest rate. And they have a lot more than that, so they have plenty to service the debt. The CEO's salary was $326,000 in 2019, now it's $1 million. Total compensation, $16 million, tenure as CEO, 5.3 years. The insiders are only selling, there's no buying. Look at all these sells, look how long this list is. About 900,000 shares were sold by insiders in the past year. 97% of the company is owned by institutions and 2% by the general public. The biggest shareholder is Vanguard at 13%, then BlackRock. You see GO, T. Rowe Price, Starboard, UBS, JP Morgan, and to round out the list, managed account advisors. Their employee count was 4,400 in 2013. Its highest was 7,000 in 2022. Now it's 6,200. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, and Sao Paulo Bolsa. So if you want to get a copy of my discounted cash flow model, watch the video in the top right corner. Thanks for watching.